Okay, hello everybody. Welcome to Korean Atlanta Mentorship. If you're new to this channel, I just want to kind of brag that I paid off a mortgage in 2 years and 9 months. Yep, you're listening to someone who actually paid off a mortgage in 2 years and 9 months. And then also, we've done demonstrations of, mortgage payoff in about 2.5 years. And I was just wondering, if everybody did this, right? Everybody paid it off in less than three. Would the banks freak out? Would the system collapse? I asked ChatGPT here, if everybody paid off their mortgage in 2.5 years, would the banks freak out? So let's go ahead and see what ChatGPT has to say.
Short answer, yes, banks would absolutely freak out, and so would the entire financial system. Here's why, in practical terms. 1. Banks depend on long term mortgages for steady income. Mortgages are one of the biggest sources of predictable long term profit for banks. If everyone paid theirs off in 25 years instead of 25 to 30, banks would lose decades of expected interest income almost overnight. Their balance sheets would take a major hit. Many would suddenly look far less valuable or even unstable. 2. It would scramble the broader financial system. Mortgages aren't just sitting at your local bank, they're bundled into mortgage backed securities and owned by pension funds, insurance companies, governments, international investors. If the underlying mortgages vanished quickly, the value of those securities would collapse or at least be extremely disrupted. 3. Interest rates and lending would whipsaw. Banks would try to replace lost profits by raising interest rates on new loans, tightening lending standards, introducing new fees. Ironically, this would make it harder for new buyers to get homes, despite everyone being debt free. 4. Home prices would probably fall, not rise. If suddenly most people owned their homes outright, fewer people would need loans. Demand, as currently structured, would drop. Prices would likely come down after an initial weird spike. Great for buyers, bad for investors and banks. 5. But society might actually be healthier in the long run. No mortgage equals more disposable income equals less stress plus more freedom. Money that used to go to banks could go to local businesses, retirement savings, education, health, and travel. The economy would shift from debt driven to ownership driven, and that's a very big transformation. TLDR, banks would panic, markets would go nuts, and there'd be chaos. But average people would probably be better off once things stabilized. If you want, I can walk through how banks would try to stop or respond to this if they saw it coming.
Well, I'll say yes, let the answer generate while we talk about velocity banking. Man, this happened in 2024 for me. I can't even believe it. You know what my next goal is? Probably to make $1 million. So you don't have to make $1 million to pay off your debt. And if you did, probably what would happen is that like you'd probably go for, a house in the millions of dollars, ironically making it harder for you to pay off the mortgage, right? So my home value when I bought it was like 300 and then paid off in 2 years and 9 months. So anyways, all right. So what is the title of the thumbnail for today? It is "The Banks Will Collapse If We All Do This," right? They'll all freak out, they'll all collapse. Uh, oh man, they'd make borrowing look irresistible again, right? Mortgage equals tax benefits. Strong marketing. Your money works better invested than used to pay off a 3% loan. All right, so let's go ahead and get started. Velocity banking, what is it? Debt payoff strategy, where you throw all of your money into debt using something called a line of credit. So, first step to doing velocity banking is creating a budget. So, we have the average American budget right here. And if you're new to the channel, the way that I always present it to somebody who's brand new is that I always hide the thing about velocity banking and I say, hey, if you make great income and you have all this debt, right, and you have $1 left over, do you need to make more money to get out of the hole, right? That's pretty much what I say. And then you can see right here, if you look at the expense breakdown, we have all this debt: 10 credit cards, a auto loan, a mortgage, and then we have our non-debt expenses, which is $3,000 a month, right? $3,000 a month. So what we're going to do is we're going to take the same income and the same expenses and just kind of shift the flow of money, right? So a lot of people when they see this, it's like, well, this is this is very bad. $1 left over. We need to make more money. Now let me do something even crazier, which is put this to zero, right? So we take a look here. We take a look here, and then we see that this is what I've pretty much done with my checking account is that money comes in, right? Money comes in, and then it just goes right out, right? It just goes right out. So, yeah. Where does it go? It goes into something called a line of credit. So, what is a line of credit? Basically, a financial tool where you could borrow money, pay it back, and use it over and over again. So, this is my home equity line of credit. $373,500, and then you just take a look here from the line of credit to checking, you click transfer funds, and then basically with the click of a button, you have money into your checking account borrowed at usually 8 to 15% interest rate, right? And that's where essentially all of our money will go, and we're going to focus on this cash flow number, right? Cash flow. And we're going to increase this cash flow number uh, with the help of a line of credit. So if you don't know what the cash flow index formula is, basically a formula of debt divided by a payment, and then we scroll down here. Okay, we scroll down here, and then you'll notice that this has a ranking system, and basically you pay off the smaller ones first, and then you pay off this one last, right? The big one last. Why? Because you have to give someone $200,000 to only get $843 back in your cash flow. Whereas if you want to pay off this credit card, it's only 35 grand to get even more cash flow. So that's what these ratios are for. So that's why you want to pay off the low ones first. And then we're going to assume just for this example, we have a free and clear line of credit, but realistically, you probably wouldn't get a free and clear line of credit if you had $1 left over. And the reason is because I know the secret of banking is that banks don't lend money to people who need it, right? They don't lend money to people who need it. If you go to a bank and you need money, they'll be like, what is this, some kind of a joke, right? There's a reason why they ask for your last 2 years of tax returns, your W-2s, and all that other good junk is because they want to see if you're a big risk or a tiny risk, right? It's all about risk measurement, right? When no bank wants to be no bank wants to foreclose on a property because their main goal is just to collect payments over time, right? They just want that sweet sweet payments over time because really that's how they make the money. Okay. So, by the way, if you don't know about me, I have over $739,000 in lines of credit. Yeah, $739,000, and maybe one day it'll be a million soon. I don't know. We'll see. But $739,000, and then these are also credit cards too. Credit cards, personal line, business line, yada yada yada. $739,000. Okay, and so if you take a look here, right? So take a look here. And then what we're going to do is we're going to move some of these debts into the line of credit to increase our cash flow. Now, why do we show a free and clear line of credit? Because I have more realistic scenarios in a 99-cent paywall. So if you want to see the more realistic scenarios that are juicy and good, for example, 22 debts with $4 left over, oh, that was one of the best live streams I ever did, right? So I remember it was like last year in the summer, somebody just like cold emailed me, say, hey, um, can you review my scenario? And usually I don't like doing free work, but because I gained such an educational opportunity to learn from that, like I was like, I got to do this. I got to do this. 22 debts and $4 left over. Amazing. Join the YouTube channel for that 99 cents. Anyways, all right. So we take a look here. But the way that I usually like to present it is that this is kind of like having car insurance before you crashed your car. Well, actually, it's like this is a car crash. This is like car insurance after you crashed your car without insurance, right? Like you got car insurance, and somehow you're able to get it after you crash your car without car insurance. Be amazing to have that, but you won't get it. Okay. Anyways, all right, so let's go ahead and do this, and we take a look here. So 5, 8, 15, 27, 37, 10, 35, 35, 12, 15, and then I'm going to go ahead and sum them up. And so this is going to be 164,000. $164,000 of debt. Okay. And then what we're going to do, or actually, not what we're going to do, is now that we have $164,000 of debt transferred, well, guess what happens to these payments here? Take a look at that. Whoa. Whoa. And this is the most like, this should be probably the most mind blowing part because income is the same, right? Remember how you looked at this and you were like, well, we need to make more income, right? Do we? How do we turn a dollar into 5,000? I don't know. That really should show you how much the bank is sucking from you through credit cards and interest payments, right? So that's why they talk about collapse or freaking out. Um, but they would try to make sure that you never do this, right? In fact, let me go ahead and read this. Let me go ahead and read this and see what's up.
If banks and governments saw a world coming where everyone was about to wipe out their mortgage in 2.5 years, they wouldn't just sit there. They'd move fast to protect the lending system. Here's what that response would probably look like, step by step. One, they try to lock you in. Banks would change the rules of the game before you finish paying off. More early payoff penalties, longer fixed terms with higher fees to break. Mortgages structured like car leases you never truly own until the end. More balloon payment loans where the final chunk can't be rushed. The goal, stop mass early payoffs. Two, they'd make borrowing look irresistible again. If people stop needing loans, banks die. So they'd pivot. Super low teaser rates, cash out refinance, offers everywhere. New incentives like mortgage equals tax benefit. Strong marketing. Your money works better invested than used to pay off a 3% loan. They'd normalize staying in debt again. 3. Governments would quietly support them because pensions, funds, and governments all rely on mortgage bonds. Mortgage interest could become even more heavily tax deductible. They might create first-time buyer subsidies that require a loan. Encourage
Uh-oh,
longer
40 to
mortgages.
50 year
40
terms.
to 50 year terms become normal. Propose new home access programs that keep banks central, Lithos. This would be sold as help for affordability, but it's really about maintaining leverage. Have 4. New types of forever housing finance. If traditional mortgages stop working, new models would appear. Subscription housing, you pay forever but never
Isn't
finish.
that renting?
Corporate co-ownership of homes, you own 60%, they own 40%. Bank-owned neighborhoods with lifetime financing. Rent to own in name only. Ownership becomes blurred on purpose. 5. Prices would be steered upward artificially. To force people back into needing loans, credit would expand again. Investors and institutions buy up single-family homes. Zoning plus supply manipulation keeps prices high, normalizing 6 to 10x income housing costs. If homes are affordable, people don't need banks. So they'd resist that hard. The uncomfortable truth. Paying off debt en masse is one of the most powerful things ordinary people could do and one of the biggest threats to modern banking. That's why the system is designed to make long mortgages equals normal, debt equals smart, owning outright wasted opportunity. If you're curious, next I can explain the personal strategy that gives you mortgage freedom without triggering penalties or relying on perfect discipline,
All right, so now
the kind that banks hate because it quietly works.
I think we're talking about velocity banking, but now let's go to the final step of paying off the credit card debt, which is the entire 9,000 goes in as an overpayment into the line of credit. You take 4,000 out, and every single month, $5,000, the balance goes down. So let's go ahead and do this. So 5111.83, okay? Not 4111, 5111. And then what we do is we take the average daily balance to calculate the interest, multiply it by the interest rate, and then divide by 12. All right? And then this one is I2 plus 1. And then this is going to be, all right? And so now we see that in 37 months, debt's paid off, whoop-de-doo. Okay? All right, so now this is going to be 37 months, 164K. And then I'm going to go ahead and do this. And then we see that there's an auto loan and a mortgage here, auto loan and a mortgage. And then it's going to be, let me see, 37 months. So we have a loan calculator right here. So we can just type in the current month and they'll give us the latest balance, cash flow index again. and then I'm just going to do that right here one more time. So this is the current balance of the auto loan. We'll move it into Z line of credit, 160045.43. Okay, and then we get an extra $718 back in our cash flow, and now it's $5,830.58. And then, right, so now this is going to be 5830.58. Okay, so now it's 39 months. All right. All right. And then so now let's go ahead and do this, which is 20404K. And then now the mortgage is $200,000. And what is the current balance of the mortgage? You just put 39 right here, and there's 185 grand balance of the loan, right? And then what we're going to do is do something called chunking. So I already kind of filled this out. So let's say we did $10,000 swipes on a 30% credit card. We can still pay it off in 2.5 years. You see this current balance right here, right? And we pay 11 grand in interest. If we use an 8% line of credit, 7 grand, right? 0% line of credit, 6 grand. Okay. Folks, let me tell you something. Don't move an entire loan into a line of credit if the interest rate is really high. Like if I do this and I move this into a line of credit, well, it's the worst situation out of all of them. It's still pretty good, 20 grand, 2.6 years, but I can use a 30% credit card and pay only 11 grand, right? See, kind of tricky, right? Math's not always obvious. All right, well, 2.5 years. Let's go ahead and do that and pay up. Yeah, that's the kind of the title of the video. Pay off a mortgage in 2.5 years. And it's funny because like I actually think this would happen where like the banks and governments would kind of just like get into a huge marketing campaign. And this is pretty good. Super low teaser rates, cash out refinance offers everywhere, mortgage equals tax benefits. Oh, your money works better invested than used to pay off a 3% loan. Okay, so let me go ahead and do this. And then this is going to be 0, and then it's going to be 39 divided by 12 plus 2.5, right? So that's going to be 5.75 years, and then we're debt free. All right, well, that's it for today, folks. Freelance mentorship here with another video with another. And here's the thing: I think I'm gonna hire someone to do my SEO. Maybe someone on Fiverr or Upwork, because I actually did a Google search. Okay, a Google search, or I'm sorry, YouTube search incognito, and I typed in velocity banking. Everybody's video except mine was on the first page of the channel. I was like, what's up with this? And everybody tells me I'm the best. Anyways, all right, well, that's it for today, folks. Have a great day, and I'll see you on the next video.